Hey guys, so in this video, I'm going over my top 6 stocks for the month of February 2021. I am obsessed with the stock market and I've spent the last month analyzing hundreds of stocks. This is my list of stocks that I think are the best buys right now. Be sure to watch all the way through to get my full analysis on each of these companies. I'll go over key numbers, recent news, and why I expect them to grow. Huge shout out to WealthFRONT for sponsoring this video. So let's get started. First stock on my list is NIO, stock ticker NIO. This is an electric vehicle and battery company that's headquartered in China. Right now they have 4 very good looking cars on the market with more to come. So right now NIO is trading at $57.11 with a 52-week low of $2.11 and a 52-week high of $66.99. So right away, you guys can see that this company has grown so much in the last year. If we take a look at their 1-year price chart, we can see that their stock price was hovering under $10 for a long time. And since June or July of 2020, that's when it really started to grow. We had a huge rush followed by a correction. And since then, NIO has been trending upwards. This company has a market cap of $89.029 billion. And since they are not yet profitable, we do not have a PE ratio. Their earnings per share is negative $44.10, and they do not pay out a dividend. Looking at their valuation measures, we can see that they have a price to sales ratio of 34.86 and a price to book ratio of 77.97. As far as profitability, like I said, they are not yet profitable with a profit margin of negative 56.26% and also a negative return on equity of negative 116.34%. Their balance sheet, however, shows a very good current ratio of 2.42, which means that they have 2.42 times the current assets as current liabilities. And it's always interesting to see what analysts have to say. So on a scale of 1 to 5, 1 being a strong buy and 5 being a sell, NIO is rated as a 2.4, meaning it is between a buy and a hold. The average analyst price target is $49.59, which is about 15% lower than the current price of $57.11. Now, when I recommend NIO, it's not me pushing you guys away from Tesla. In fact, I think that Tesla is a tremendous opportunity still, but I've talked about Tesla to death on this channel since they were like at a few $100s pre-split. NIO is another fantastic electric vehicle opportunity that I really think has the potential to grow massively. However, that being said, it is on the riskier side because it is very volatile. We may see some pullbacks in the short term, but that would present even better buying opportunities. And long term, I don't think it really matters what price you pay for the stock. In 2020, EV sales in China crossed 1 million cars, and that is such a small number compared to where this market will be in the next decade. Since NIO is not yet profitable, we can take a look at its price to sales ratio of about 35, which is a little bit higher than Tesla's of 30. Their recent NIO Day presentation announced a new luxury sedan called the ET7, which has a huge 150 kilowatt hour battery pack. Now, some people are wary investing in Chinese companies, but I think it could be a big selling point here. Faced with competition from other EV companies like Tesla, it's popular opinion that the Chinese government would want to see a Chinese EV company grow massively. These companies provide a lot of data and the Chinese government wants to be in control of that. EV infrastructure in China is also improving and buying EV cars is becoming more and more trendy. Also, its batteries as a service BaaS business model will create a lot of recurring revenue. There's a lot going on for NIO, and if you're big on the shift from internal combustion engine cars to electric vehicles, then NIO is definitely a stock to watch. I repeat, this is definitely a short-term speculative investment, so you should be prepared for some pullbacks. But in the long term, I do think that this company has a lot more growth ahead of it. Number 2 on my list is Microsoft, stock ticker MSFT. This is a multinational technology company that's based in the US, and they make computers, software, electronics, services, and so much more. It is a rather boring stock, but one with a lot of growth potential. So right now, Microsoft is trading at $232.90 with a 52-week low of $132.52 and a 52-week high of $240.44. We saw Microsoft take a pretty big hit with the pandemic, but ever since then, it's been on the uprise to hit the low 200s. Microsoft is a huge company with a market cap of $1.761 trillion. They have a PE ratio of 37.57, an earnings per share of $6.20, and a small dividend of 0.96%. They have a 5-year expected price to earnings growth ratio of 2.61, and their price to book ratio is 13.84. Microsoft is wildly successful with their profitability, and right now their profit margin is sitting at 33.47%. They also have a sky-high return on equity of 42.7%. They're sitting on a whopping $131 billion of total cash, and they have a very great current ratio of 2.58. Analysts currently rate Microsoft as a 1.6, meaning it is a pretty strong buy, and the average analyst price target is $244.25, which is a tad higher than the current price of $232.90. So Microsoft just reported their Q2 2021 earnings, and wow, these numbers are really good. They hit revenue of $43.1 billion, which is about 7% higher than expectations. Their earnings per share was also 25% higher than expected, and their cloud and personal computer sectors crushed it as well. Gaming revenue topped $5 billion for the first time due to the new Xbox release, and Microsoft has said that they expect double-digit gains in revenue and profits for the full fiscal year ending in July 2021. The cloud industry is growing a lot, and Microsoft is the second biggest cloud provider just behind Amazon. They've also announced exciting partnerships with Cruise and GM, in which Microsoft would be their preferred cloud provider. I know Microsoft is not the most exciting stock, but we are investing to make money, right? In the long term, you really can't go wrong with Microsoft. They have fantastic numbers, the right teams in place to grow in the next decade, and they are in heavily growing industries. I mean, they hit $40 billion in quarterly sales for the first time and $15 billion in profit, which is why their stock jumped after the earnings were announced. Azure, which is its cloud computing business, grew 50% in quarter two, which is astonishing. Overall, we will see tremendous momentum for Microsoft that should really help its share price in the coming months. It's a really great, safer long-term hold than most other companies, and that is why I'm adding more of it to my portfolio. So I want to take a second and thank this video's sponsor, WealthFront. We all want to pick good stocks, but actually it can be very difficult, time-consuming, and risky to pick individual stocks. That's where WealthFront comes in. They are a robo-advisor, and they use software to build you a globally diversified portfolio of low-cost ETFs and manage it for you. If one of your New Year's resolutions is to increase your revenue streams or start a new business, let WealthFront take care of your investments so that you can spend time focusing on building your income. So here's how it works. The app will guide you through some questions to determine your financial goals and risk tolerance, and then it will design a strategic portfolio that's right for you. WealthFront offers many account types such as retirement accounts like a Roth IRA or traditional taxable accounts like any other brokerage. This is your personalized financial advisor, except it's way more affordable and perhaps even smarter. And the app is very well designed and intuitive to use. They also help you look for opportunities to lower your tax bill through tax loss harvesting and other methods. Right now, you can get your first $5,000 managed for free using my link in the description. And after that, it's just a super low 0.25% annual management fee. Use the link below to check it out. Okay, the third stock on my list is OPENDOOR, stock ticker OPEN. This is an online real estate company that has a really interesting business model. Being in real estate myself, I feel like I have a solid understanding of market disruptors, and OPENDOOR is definitely doing that. They allow people to sell their homes as is, then they basically flip it and sell it for a profit. When done at scale, this can make a lot of money. So right now, OPENDOOR is trading at $25.18 with a 52-week low of $10.55 and a 52-week high of $32.39. If we take a look at their price chart, we can see that their stock has been fluctuating in price a lot, but right now it is trading under its all-time highs. They have a market cap of $13.709 billion, and we don't have enough data to know their PE ratio or earnings per share. They are not yet profitable, and we see a profit margin of negative 8.1%. They have total cash of about $550 million, and they have a very great current ratio of 5.16. Now, we have very little data from analysts, but right now the rating is at 1.7, meaning it is a buy. And the average analyst price target is $32.50, which is quite a bit higher than the current price of $25.18. So OPENDOOR's SPAC merger closed on December 17th, so it is a very new stock that is trading under its highs. Right now, quarter four stats have not yet been released yet, but we do have some information about the company's revenue. In 2019, they brought in $4.7 billion in revenue, although that did decrease substantially in 2020 due to the pandemic. Now, they are not yet profitable, but once their frictionless business model picks up steam, I think profits will be plenty. Their sophisticated algorithms allow OPENDOOR to really be spot on with their home analyses, knowing exactly how much profit is in each deal based on all the factors like buy price, renovation costs, and more. It's also priced relatively cheap compared to some of the other big real estate internet companies like Zillow and Redfin. Now they are applying e-commerce and tech to the real estate buying and selling process, which I believe is a big disruptor in a very traditional industry. Overall, I think the stock is better for people with some short-term risk, but in the long term, I think OPENDOOR will do very well with its share price. And that is why I'm adding more of it into my portfolio. Okay, next up on my list is Square, stock ticker SQ. This is an American financial technology company that's from California that makes point-of-sale software and hardware and also offers financial and marketing services. Right now, Square is trading at $202.46 with a 52-week low of $32.33 and a 52-week high of $246.49. Looking at their 1-year price chart, we can see that this company has performed exceptionally well in the last year, and they are just off their all-time highs. Square has a market cap of $91.297 billion, a PE ratio of 307.22, which is insanely high, earnings per share of 66 cents, and they don't have a dividend. They have a 5-year PEG ratio of 4.45 and a price to book ratio of 48.72, which is also extremely high. Now looking at its profitability, Square has a profit margin of 4.05%, and the return on equity is pretty good at 18.72%. They're carrying total cash of about $2.88 billion, and they have a current ratio of 1.7. Right now, analysts currently rate Square as a 2.4, meaning it is between a buy and a hold. And the average analyst price target is at $222.60, which is about 10% higher than the current price of $202.46. So as you saw, Square has performed extremely well over the last half decade, and yet there's still so much upside in my opinion. They started with point of sale systems that allowed small businesses to take credit card payments, and recently started focusing on their Cash App, which allows person-to-person payments. You know why I think Square has so much upside? Well, they are less than 2% penetrated for the P2P Cash App business and 3% penetrated for their point of sales business. The digital payments market could reach $2 trillion in the next 5 years. Value investors won't like the numbers for Square, and it appears grossly overvalued to many. But if you look at the future growth for this company, I would disagree. Right now, Cash App has 30 million monthly active users, and in the last year, their gross profit is up 200%. Square's revenue is increasing rapidly, in large part due to Cash App. And guys, whenever I see companies using influencer marketing heavily like Square does, I know that they have a huge advantage in gaining new customers. They have a very wide ecosystem of products in the fintech sphere, which will undoubtedly grow in the next decade and beyond. So yeah, overall, I think that Square is a very great pick for a long-term stock. Number 5 on my list is ARK Innovation ETF. Stock ticker ARKK. This one's a little bit different than my other picks, as this is not a single company stock. Rather, this is an exchange traded fund that has multiple high innovation companies. That means it should give you great growth potential, but also limit the risk a bit through diversification. So right now, ARK Innovations ETF is trading at $138.41 with a 52-week low of $33 and a 52-week high of $149.85. Looking at the price chart, you can see how well this ETF has done. And it's pretty much just been straight growth since the start of April 2020. For ETFs, I like to look at their sector weightings. So for this one, consumer cyclical makes up 10.8%, financial services is 5.62%, healthcare is 31.56%, communication services is 24.42%, and technology is 21.44%. We can see that the average price to book ratio for the companies in this fund is 9.98, and the average price to sales ratio is 10.44. Now their top 10 holdings is also very interesting to look at. So for this one, Tesla is their top holding at 10.79% of assets. After that, we have companies like Roku, CRISPR, Square, Teladoc. Yeah, a bunch of these companies that I have talked about on this channel before. Looking at the performance overview, we can see that there's a year-to-date daily total return of 17.82%, and their 1-year daily total return is 182.26%. ARK Innovation ETF is a fund led by Cathie Wood, an experienced investor who in the past year has blown people away with the performance of her funds. ARKK isn't the only ETF that she oversees. In fact, she has many other ones, including ARKG, ARKW, ARKF, and more. All have performed very well in the recent years. Now, when compared to other ETFs like Vanguard's VOO or VTI, this one has performed much better recently. But that's also because companies in this fund are much fewer in number, and they are all more risky and speculative stocks. Its top performer has been Tesla, which makes up about 10% of ARKK's holdings. Cathie Wood has said that she had to sell Tesla to keep it around 10% of the fund, otherwise they'd be sitting at about 20% or more. But yeah, looking back at its top 10 holdings, you see big growth stocks like Tesla, Roku, Square, Teladoc, a lot of which I have talked about on this channel before. So if you want a more diversified approach to investing in these types of companies, I think this one can be a great choice. Now, the expense ratio is perhaps the worst part about this fund, and at 0.75%, it is quite high, much higher than the industry average. But hey, when you get Cathie Wood to invest for you, it's going to cost you. Overall, this is a very popular fund that will perform well if these more speculative companies end up going in price this year. Again, not the right ETF for everyone, but I will be adding more of it to my portfolio. All right, so now the last stock on my list is Adobe, stock ticker ADBE. This is an American multinational software company. They are well known for creative softwares like Photoshop, Lightroom, Premiere Pro, After Effects, and a lot more. Right now, Adobe is trading at $460 with a 52-week low of $255.13 and a 52-week high of $536.88. Their price chart shows a small drop back in March of 2020 2020, but since then they have grown quite well. But we do see somewhat of a stagnation in their price in the last half year. Adobe has a market cap of $220.2 billion, a PE ratio of 42.47, and an earnings per share of $10.83. They have a 5-year PEG ratio of 2.34 and a price to book ratio of 17.05. Looking at the profitability, we can see that Adobe does extremely well with this, and their profit margin is 40.88%. They also have a very strong return on equity of 44.21%. They're sitting on about $5.99 billion in cash, and they have a current ratio of 1.48. Right now, analysts are giving Adobe a 1.8 rating, meaning it is a buy. And the average analyst price target is $565.87, which is much higher than the current price of $460. Now, I am a big long-term believer of Adobe because I personally use their products and they are in such a good position as a software company. Their Creative Cloud is a software suite that is an all-in-one solution, and it's available to both individual creators as well as companies. It's on a monthly subscription, and if you've been following my analyses for a while, you'll know that I love subscription business models for their continual and steady revenue. You can either get all their apps in one or pick them individually. Anyways, let's take a look at some of their growth in 2020. Adobe's revenue was up 15% to $12.87 billion. I mentioned their profitability already, but at just over 44%, this is spectacular. Businesses succeed when they make money, and when profit margins are so high, that is super great for long-term shareholders. In 2020, Adobe also spent $3 billion repurchasing 8 million shares of stock, and they just announced that they would authorize another $15 billion in stock buybacks through the end of 2024. Their earnings per share are projected to grow by over 15% in the next year, and they are even getting into the CRM business. Now, in the creator atmosphere, more and more people are staying at home and getting creative, and I think that 2021 will be a great year for their software subscriptions. Adobe has a really big moat, meaning that it is very hard for competitors to gain market share. We have companies like Apple doing quite well with their creative softwares, but nothing yet has been able to really take a big stab at Adobe. And really, I don't see this happening anytime soon. That's why I think Adobe could be a really great stock to look into for the month of February and beyond. So there you have it. Those are my top 6 stocks for the month of February 2021. Now, for any investor, I always tell them you have to do your own due diligence. Don't buy any stock I talk about just because it's on my list of stocks. You have to do your own research before purchasing, because only you can make the right call to see if it's a stock worth investing in. In the last half year, most stocks have grown a lot. So that's why it's important to diversify your portfolio with safer companies that have strong balance sheets and are not just hype stocks. This should help you out in case there is a market correction. I also think that it is quite important to buy index funds to reduce your investing risk. Some of these are definitely riskier on this list and some are safer. But yeah, please, you guys, do your own research and trade according to your own risk tolerance and your own judgment. I wish all you guys a really great year of stock trading. Anyways, if you guys enjoyed the video, make sure to hit that like button and also subscribe to my channel to see more videos just like this. I make a ton of content about personal finance, investing, and entrepreneurship. Thank you so much for your time, and I'll see you guys in the next video. Peace.